5 months of gains on the S&P 500. Can we make it 6? Live from New York City this morning. Good morning, good morning. Equities down 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the bulls on Wall Street are getting even more bullish. Another economic data point out of China disappoints, and one presidential hopeful confronting the Fed. We begin with the big issue. The bulls get more bullish. Oppenheimer's John Stolfus looking for a record high before year-end, increasing his price target for the S&P to 4,900 and saying this: our price target assumes that the resilience exhibited by the U.S. economy will continue. Citi's Scott Croner is on board, increasing his price target and looking for 5K by the middle of next year. He says our new S&P 500 targets reflect a higher soft landing and lower hard landing probability. Clearly, we are chasing the tape. However, growing conviction in earnings growth acceleration is a key point of difference. JP Morgan's Marko Kolanovic is doing what he's done all year. He's pushing back on soft landing hopes and dreams, saying, quote, we remain skeptical of this outcome, anticipating the inflation decline to prove incomplete, leaving restrictive policies in place, laying the seeds for an end to the global expansion. Joining us now to discuss, Morgan Stanley's Michael Kushner, Aberdeen's Luke Hickmore. Luke, first question to you, sir. Which camp are you in?
I think I'm still in the recession camp. I feel torn about it, but I still feel the risk of that is very, very high. We've very, very rarely had a Fed hiking cycle of this kind of pace without a recession caused afterwards.
Michael Kushner, do you agree?
I'm more on the optimistic side. I think a softish landing is what's going to happen. Doesn't mean we won't have potentially negative GDP growth for a couple quarters, but kind of like early 2022, small negative, but with a resilient labor market, it won't feel like a recession. But slower growth, but nothing too bad.
Michael, tighter financial conditions. We're seeing it in bank lending survey after bank lending survey. We heard it from Capital Economics yesterday, who said this: despite the optimism surrounding the real economy's performance over the first half of the year, credit conditions have historically only ever been this tight during or in the run-up to recession. Michael, why is this time different?
I think it's the resiliency of the private sector, the strength of the consumer, the household, the corporate sector, the pre-planning for what's happened. The Fed transmitted exactly what they were going to do, refinancing in the housing market, refinancing of debt in the corporate sector. Won't say there won't be specific problems, won't be problems amongst the different income parts of the income distribution, or certain high-yielding companies who levered too much, or a business model doesn't work in the new environment may happen, but systematic or systemic weakness, it's hard to see. My analogy is still kind of the mid-1990s when the Fed raised rates 300 basis points in 94, and 95 turned out okay. A significant slowdown, but nothing disastrous. Fed moved to cut rates. I think that'll happen towards the end of 2024.
Luke, from your perspective, what's your key point of differentiation?
I think it's really hard to get away from a lot of corporate profits being driven by inflation. It's pushed up nominal growth. It's pushed up revenue growth. They've benefited from that as well. There's been a lag in terms of passing it through for wages. That's starting to hit. Just as inflation starts to come back down again, nominal growth is going to come back down again. The optimism that abounds at 23 times PE for the S&P 500 just seems way too far when we're coming into a period when all of that's going on. It's going to start hitting the market. I think seasonality, September, October, we've seen it before. We could just see a wobble again this year.
Luke, that's the equity side. What about the credit side with high yield spreads in and around south of 400 basis points through much of the last few weeks?
I really want to love IG credit here. It's the right time to be getting into that market. High yield, I feel, is not up with events, is not pricing our expectations of a slowdown or even a recession as far as my view is concerned. IG market should be the sweet spot for that. But it's moved so far, like the S&P, like so much of the equity markets around the world, the levels we're now seeing short term are starting to look rich again. Do you know, with cash rates where they are, with government bonds where they are, that's not a bad investment right now.
Michael, you disagree on the outlook, the economic outlook. Do you agree on the trade in the market, what you just heard from Luke Hickmore?
I think in the short term, there's no doubt that credit has done quite well in the last couple of months. High yield is, but it tends to track the equity market. The S&P up 20%. Is it surprising the high yield market is up as high, mid-single, high single digits after its disastrous year last year? How often does the high yield market have a double-digit negative return 2 years in a row, or a negative return 2 years in a row? Almost never. So I think the rebound we have is perfectly reasonable. Going forward, I still think we're on track for potential in a 9–10% return in high yield this year. Our view is more about not getting too defensive. That weakness is a potential buying opportunity, not a selling opportunity, or sell strength, buy weakness.
Michael, do you think that avoiding recession is sufficient enough for this to continue, this grind higher in equities, this grind tighter in spreads?
It can over the remainder of the summer. I think the Fed has pulled back from hiking rates. There's likely a good chance they won't hike rates at all, or not till November. We're in a period where economic data has been strengthening. The labor market is rock solid. I think there's no reason why Friday's employment report shouldn't be fine. I'm not saying it won't be below 200,000, above 200,000, but it'll be fine. The unemployment rate shows no signs of going up. The manufacturing sector may be bottoming here. It may not be weakening any further. And while the service sector is likely to continue to stay slower than it was 6 months ago, manufacturing doing a little better. Overall, it looks okay.
More economic data coming up later this week. Payrolls on Friday, 200K is the headline estimate. Unemployment expected to come in and around 3.5%. You look at that, and I would use Michael Cushman's language, things look okay. Joining us now to discuss is Bloomberg's Ira Jersey. Ira, data out a little bit later on this morning as well. What are you and the team looking for?
Yeah, so I think the ISM surveys are going to be really interesting before we get that critical payrolls report on Friday. The ISM surveys have been kind of weak and hovering near recession, but not in recessionary type levels. So I think that those will be really interesting to watch. And also the prices paid components, particularly of Thursday's services sector, because that has continued to be above 50, and we've seen the strength in prices in the services sector even much more than the goods sector. So if we see that prices paid tick up again, then that can be a sign that maybe we could get a reacceleration of inflation, particularly in that stickier services sector.
Where would it leave your outlook, Ira, if you did get manufacturing converging towards services?
Yeah, well, if manufacturing gets back up towards services, then you'd have to think that stickier inflation would be the case. I think then for the rates market, what would probably happen is we'd start pricing out some of the cuts that are being priced for the first half of 2024, and if that happens, you wind up probably with kind of a bear flattening of the yield curve, which is pretty unusual to occur.
Given where yields are right now, 10-year at something like 4%, Ira, do you think the disinflationary momentum that we've witnessed over the last month is sufficient just to chase yields lower from here, or do you want to see more?
Yeah, I think it is. I think a big part of that is a big part of what would get 10-year yields significantly lower has to be that inflation doesn't reaccelerate, right? So the opposite of what I just said, effectively. So as long as inflation continues to come down toward levels where the Fed's not hiking anymore, then ultimately the market's going to price for the Fed at some point in the future. I'm not saying in the next 6 months or 9 months, but maybe in 2 or 3 years for the Fed to cut, say, below 3%. And if that happens, and the market expects the Fed to stay at, say, 2.5% for a long period of time, then you wind up with 10-year yields that can rally quite significantly. It doesn't necessarily mean that the front end has to move very much, but the back end would probably rally in that scenario.
Ira, thank you, sir. Ira Jersey of Bloomberg Intelligence on the rates market and the economic data out a little bit later this morning. Job openings coming up, of course, alongside ISM manufacturing on to Friday when we get the payrolls report. Michael, you alluded to it. That spread right now between services resilient, manufacturing dreadful. Do you actually think manufacturing can start to converge up towards services?
Well, I think there's been a lot of technical factors driving manufacturing weaker, both in terms of pent-up demand during the pandemic, or 2021 into 22, which satisfied a lot of forward demand. Inventories got built up too much in 22, had to be run down. Imports are still falling year on year right now in the United States, which doesn't augur well for manufacturing in the short term. But on the other hand, you talk about global deglobalization, re-onshoring, the CapEx boom, government subsidies to manufacturing chip plants, solar energy, manufacturing. All these things point to demand for capital, demand for build things. I bet you I don't know for sure, there's a shortage of workers. Some of the constraints on building things will be the absence of the ability to hire people to staff factories and things like that. So I do see the manufacturing not weakening. How much stronger it gets, I'm not sure. Service sector clearly has to soften a bit. We're not saying the economy won't be strong. I don't think 2.5% GDP growth annualized is going to continue in the second half of the year, but it's not going negative.
Luke, are you taking the other side?
A little bit, I guess. I agree completely with Michael about the onshoring, but there's an whole other thing going on here as well called friend-shoring. So look at Japan, look at the rise in the equity market there recently. A lot of Southeast Asia democracies are taking business away from China as well. It doesn't just have to be the US that sees the employment growth there and actually a tight labour market continue. And in the meantime, we've seen a lot of layoffs recently in high-paying, white-collar jobs, knowledge industries. That's going to hurt the economy broadly as well. I find it really, really hard after 3-4 years of real wage decreases for either the consumers to continue where they have been doing or companies to actually continue with a cost base that's affordable when revenue growth is starting to run out. So yes, we may get a capex increase. We may get 1 or 2 decent quarters of earnings, but that slowdown's coming along. It may not turn into a recession, fair enough, but I think it could end up feeling a bit like it.
Luke Hickmore, Michael Kushmer, you're both going to stick with us. Let's get you some movers going into the opening bell. Equities right now just a little bit softer. The Open, Abby, about 20 minutes away.
Indeed, John. And despite that softness, we do have a couple of big winners to take a look at relative to earnings, starting off with the shares of Arista Networks, up more than 10%. At this point, up 14.4% as the cloud and communications networking company beat and raised. That was the type of quarter they put up, very strong, and analysts encouraged by the fact that it was a diversified revenue streams. Uber up 1.25%. They reported their first ever operating profit. It was fueled by demand for rides and delivery. Ridership also reached a record, so those shares being rewarded. But Norwegian Cruise Line, not so much, down 10.3%. The adjusted earnings for this quarter, they guided to 70 cents. The estimate on Wall Street, John, had been 79 cents. They raised the full year view. Some more color is needed on this beneath the surface. Yields appear to be holding, cost weighing. As you know, these stocks up huge. Into today, up 80%. Price for perfection. Investors didn't get it. Stock is down.
Abby, thank you. Coming up on this programme, the disappointing data out of China continues.
I guess one thing is just we have to lower the expectation for China's growth. The past 3 years, we have seen plenty policy that's a bit damaging, let's say, for a couple of sectors there. It's a very slow healing process here.
That conversation up next.
On China, I think many people expected that coming out of COVID that it would rapidly go up. That has not yet happened. There's been some signs from the government. They're taking some action, but we will see how that unfolds in the second half of the year. Things that they're doing on the real estate side to maybe get that situation going a little bit might have a positive effect on consumer sentiment. We shall see, but I think it's too early to tell how that's going to develop.
More disappointing economic data out of China. Manufacturing contracting in July, falling to a 6-month low. Monthly home sales dropping the most in a year, underlining the need for further government support. This as Beijing delivers another pledge to jumpstart the recovery, including boosting consumer and business spending, reviving the housing sector, and perhaps cutting rates. Bloomberg's Tom Orlick joins us now for more. Tom, you're an expert on this part of the world, and I'm going to lean on you to tell me what they're actually doing. Not what they're telling us, what are they doing?
So the cavalry is on the way, Jonathan. Unfortunately, relative to past cavalry arrivals, this one's looking rather lackluster. We're not talking about a 100 stallions here. We're looking at a few rather mangy-looking old nags riding up to support China's economy. 2008, they delivered $4 trillion in stimulus, enough to restart the economy, but also leaving them with a huge legacy of debt. That legacy of debt now making it rather hard for them to deliver enough stimulus this time round.
Tom,
So
are we
the
starting to
PBOC's
see... Sorry to jump in, Tom, but do you think we're starting to see an emerging balance sheet recession that they can't do much about?
So the balance sheet recession analogy, Jonathan, comparing what's happening in China now with what happened in Japan in the 1990s, has a certain amount of resonance to it. China, like Japan, has got a huge amount of debt and a huge amount of overcapacity. Producer prices in deflationary territory and consumer prices, well, the CPI is close to zero. So there are some comparisons which make sense there. At the same time, there are also some big differences. Japan in the 1990s was already a rich country. They'd run out of space to grow by catching up to the global technology frontier. China's GDP per capita is just a quarter of the level in the United States. That means a bunch of development space ahead of them. China's policymakers are also keen students of history. They've looked at what's happened in Japan in the 1990s, and they'll be taking steps to ensure they don't have a repeat performance. That's why we've seen a certain amount of policy support coming in. The PBOC's cut interest rates. They've instructed banks to guide mortgage rates lower. We expect them to do more in the months ahead. There's also been some important signalling. The government spent much of the last 3 years cracking down on the private sector. In the last few weeks, they've really reversed on that and indicated firm support for the private sector, firm support for small businesses and entrepreneurs. Is that going to be enough to get China's growth back to the go-go years? Absolutely not. Debt's a problem, overcapacity is a problem, demographics is a problem. They'll do a bit more than 5% growth this year, but in the years ahead, we're looking at a 4% on the upside. But do they have enough firepower to prevent a slump, prevent a slide into a Japan-style malaise? I think they still do.
Hey, Tom, wonderful to get your input, as always. You wrote the book, literally, China, the bubble that never pops. Tom Warlick there, down in Washington on the latest. Michael Kushner, Luke Hickmore alongside us with some thoughts on this. Michael, this is what a lot of people who along, say, places like Europe, hoping that global growth picks up, this is what they're pinning their hopes on, that China can do something about growth that's disappointed so far in 2023. Do you think they can?
They do have policy levers to pull. They've cracked down on the housing market. Everyone thought, well, we certainly thought they might come to the rescue a year and a half ago to the property market, given how important it was for the economy. They didn't do it. They continue to focus on debt reduction and reduction of leverage in the system. That obviously has to continue to get things back in balance. But on the other hand, like today, we're seeing a slowdown in post-COVID opening, that the economy is not recovering. I think ultimately the problem is that we had a manufacturing boom the last couple of years post-pandemic. China benefited from that, exporting things to the rest of the world, and that's come to an end. We've had a service sector boom. China is not well positioned to benefit from a service sector boom, and going forward, how are they going to grow and catch up to Japan and other parts of the world unless they grow the non-manufacturing part of their economy?
Massive week of gains in the equity market last week in China, biggest week of gains of the year so far. Luke, it's easy to identify where the hope is right now. The hope is they deliver something big and growth starts to kick in with a little bit more strength than we've seen so far in 2023. Luke, do you share that hope?
Yeah, I guess I do. I think China is important for us all, and we are still a long way off from thinking about China as its own economy that's just enclosed, that's mostly domestic, that's shifted its manufacturing base to more of a domestic demand. That's years and years away. We all need China to be doing well. We need them to recognise they've got an important place in the world politically and economically, and actually be part of it. And I think that's been part of the issue recently is, they've been trying to find, or Xi Jinping's been trying to find his space and what he thinks the country should be doing. And it's been holding it back, I feel. And that may be starting to change. Some of the noises recently may start to change as well. But short term, let's see the stimulus come in. Let's see what it is and how it's likely to react before we can get too excited about China as an equity market from here through.
Luke, elsewhere, are you seeing more opportunities within EM versus DM right now. And I bring that up because we're talking about China potentially taking on more of an easing posture. And we're talking about rate cuts in emerging markets as we talk about the end of rate hiking elsewhere.
Yeah, for some of my unconstrained funds, we've been buying a bit of emerging market debt. And it's really trying to get hold of this change in the rate cycle, which happens there first. I think we'll see a lot of that coming through in places like Mexico and Latin America. They put their rates up a lot quicker, a lot higher. They'll come down the other side too. So local currency EM debt seems to me a pretty good place to be right now. We've been just allocating more to it as well. We've seen clients coming into that space too. And I think it's a good market to be early and still get good carry if it's going to take longer than you expect for rates to come down.
This is the final question, Michael. Have we found some common ground between you and Luke? EM.
I think we have. Local EM has done very well. We've seen rate cutting cycles begin in Hungary at the margin, in Chile. These things could be very rapid. In places like Brazil, real rates are very high. You could potentially see 400 or 500 basis points of rate cuts and still rates be on the high side. And with the inflation cycle turning in the U.S., it's low in China. Importantly, commodity prices, food and energy needs to stay reasonably under control. That's a very big component of the inflation story in EM, and falls in those inflation rates allows central banks to adopt a greater easing cycle, strengthen their currencies, further bolster the ability to cut rates. And you get into a virtuous circle of falling rates lead to capital inflows, lead to currency strength, leads to capital inflows, leads to further rate cuts. And you get this very positive cycle, which can last a while. And we're only beginning the rate cutting cycle. So we could have 12 months of really good outperformance in that sector.
That is the EM dream, described by Michael Kushmer, alongside Luke Hickmore. To the two of you, thank you, gents, as always. Going into a central bank decision later this week from Brazil. Let's see if they follow Chile, who cut rates pretty aggressively going into last weekend. Equities right now, negative 0.4%. Coming up the morning calls and later, JP Morgan's Monica DeCenso says stocks are heading to another record high. That conversation up next. About 4 minutes away from the start of a brand new trading month on the S&P 500 going into it. Futures slightly negative, we're down 1/3%. That's the price action. Let's get you some morning calls. Atlantic Equities upgrading Goldman to neutral, seeing limited downside and encouraging signs from the company's latest earnings report. Your next call from Citi, downgrading Estee Lauder to neutral, expecting a slower recovery given the recent weakness out of China. And finally, Cantor downgrading Rivian to neutral. $29 price target, citing valuation and competition concerns. That stock is down to about 27 in the pre-market, negative here by almost 1.7%. Coming up next, JP Morgan's Monica DeCenso raising her outlook for the S&P 500, expecting stocks to hit a new all-time high within the next year. That conversation up next. Your opening bell just around the corner. Let's get trading started officially for the month of August. Equity futures going into that opening bell, negative here by 1/3% on the S&P and the Nasdaq, down about 0.4%. 5 months of gains on the S&P 500, longest monthly winning streak going back to 2021. Can we continue the winning streak? There's the opening bell. Switch on the board and get to the bond market. Your 10-year yield shaping up as follows. Yields up and away this morning, higher by 5 basis points, back through 4%, 4.0129% on a 10-year yield. A little bit later this morning, 30 minutes away. ISM manufacturing and job openings in America. In the FX market, a bit of dollar strength, a bit more against the yen and sterling against the euro. We're negative by 0.2%, 109.76. It's a break of 110. In the last couple of days. In the commodity market, we pulled back on crude, $81 on WTI. We're negative there by 0.7%. Crude, over the last month through July, best month of gains, Lisa was telling me a little bit early this morning, since early last year. So decent month of gains so far for crude, and let's see if it continues into August as well. One stock to watch at the opening bout, Caterpillar, shaking off slowdown concerns and posting better than expected Q2 earnings. The CEO saying this: our results reflect continued healthy demand as we achieve double-digit top-line growth. Abby has more. Hey, Abby.
Hey, John, and this is really a very impressive quarter and a tell, to your point there, potentially on the global economy, that this recession that we've all been waiting for, well, it's really not showing up in these results. They beat in a big way. Specifically, they put up $5.67 in adjusted profit on $16.5 billion of revenue. Not small numbers. That represents a 5.7% and a 25% beat. That's the degree of strength that they are seeing. So very resilient demand for the company's iconic yellow machinery across all of the business segments. Double-digit revenue growth, machinery growing by 16%. Compare that to your Microsofts and a lot of the other big tech companies. Caterpillar is blowing them right out of the water. So this is one of the companies, many companies, I should say, that has successfully handed along higher prices. But on big ticket items, the stock, John, right now having its best day since June 7th on the year, up more than 10%. Caterpillar is certainly a piece of the breadth that we're starting to see for the market rally.
Let's see if we see more of it for longer, up 3% this morning. Abby, thanks for that. Some mixed results elsewhere from Big Pharma. Merck raising its annual sales forecast. Pfizer trimming $1 billion off their own outlook, but remaining optimistic, saying this: despite a few revenue challenges, we believe we're positioned for accelerated growth in the second half of 2023. Simone Foxman has more. Hey, Simone.
Yeah, John, Pfizer cutting about $1 billion off of its full-year sales forecast, but keeping its full-year guidance on its COVID shot and pill at $21.5 billion. However, it says that those drugs are responsible for a second quarter revenue that declined by 54% from a year ago quarter. Ex-COVID sales growth, that's the big focus of investors, because they revised their estimates down to 6 to 8% for the year versus 7 to 9% as it was earlier. Where does the growth come from now that the pandemic is past? That's a big question. Merck having a bit of an opposite problem. It actually saw better than expected results from its two top drugs. Cancer drug Keytruda, second quarter sales up 19% from the previous year. HPV shot Gardasil, second quarter up 47% year on year, especially because of increased demand in China. But investors really trying to figure out, where does the growth come next? Both of those have patents that expire in 2028. So looking to the end part of this decade, John.
Simone, thank you. Pfizer pretty much unchanged. Merck a little bit higher, up by 1.7%. JP Morgan reiterating its bullish view on Merck following its results. The analyst saying, we continue to view the company as having one of the cleanest paths to upside to both near-term and longer-term numbers in the group, estimating double-digit EPS growth through the late 2020s. And while shares have re-rated over the past year, we continue to see the stock as attractive. We remain overweight. Merck is up by close to 2%. Getting back to earnings, shares of Norwegian Cruise Lines are sharply lower after delivering weaker than expected Q3 guidance. The CEO saying, quote, we are focused on sustaining this momentum by capitalizing on robust demand and ultimately charting a path to reducing leverage. Katie has the story. Hey, Katie.
Hey, John. Yeah, Norwegian shares really plunging in the wake of that report, currently off by about 10% or so. They were lower by as much as 16% pre-market. And to get into the numbers here, Norwegian sees adjusted third quarter EPS at 70 cents. Analysts were looking for closer to 79 cents. And that's dragging down the stock, even though the company beat on its earnings and it lifted its full year EPS outlook. And actually, Norwegian is on track to sail more customers this year than it did pre-pandemic in 2019. You wouldn't know that by looking at the shares necessarily. It's dragging down its peers as well. Think Carnival and Royal Caribbean this morning. And it's probably because, in part, the bar is really high for these names. If you look at an S&P index of hotels, resorts, and cruises, currently up about 45% this year. That is double the S&P 500's performance. 3 of the top 10 stocks so far this year before today were cruise lines, which is just kind of nuts. Katie, thank you. It's been that kind of year so far. Let's wrap things up with Uber, out with earnings this morning, reporting its first ever operating profit, fueled by record demand for rides and deliveries. The CEO, Dara Khosrowshahi, saying these milestones were achieved through a combination of disciplined execution, record audience, strong engagement. We are well positioned to sustain long incremental profit generation. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. The stock is down 5.5%, completely reversing direction from pre-market trading. Broadly, the sell side sees this as a solid quarter. Net income of $394 million was a surprise. Analysts were expecting a loss of $49.2 million. Record ridership volumes in the quarter, but you have to realize that a big factor behind net income was unrealized gain in equity investments, which was a large contributor. It's the first ever profit on a GAAP basis, $326 million, free cash flow $1.14 billion. They're forecasting gross bookings of $34 to $35 billion in the third quarter, ahead of expectations. Adjusted EBIT will be $975 million to $1 billion, ahead of expectations. We also got confirmation that CFO Nelson Chai will step down effective January 5th. That confirms the Bloomberg reporting from early July. The search for his successor is underway. Number of trips, gross booking, active drivers all hit record levels in the quarter just gone, which tells you both about the demand but also the supply picture. The freight unit continues to see losses on an adjusted EBITDA basis. Finally, John, headlines from the call. Uber CEO Dara Khosrowshahi addressing the idea of competition with Lyft, and saying that for the time being, this is going to remain a two-player market for, quote, some time, acknowledging also that Lyft is being more competitive on a pricing basis. Right now, a lot of focus on continued growth in both grocery and delivery for Uber Eats.
Lyft also down this morning. The earnings about a week away, a week today. Ed, what do you learn from this release from Uber about Lyft next week?
Yeah, it's interesting that they acknowledge the effectiveness of what Lyft has done with its new CEO in response on pricing. Insurance costs have been a really big factor for Lyft in the prior two quarters. Going to be asking Dara Khosrowshahi about if they also are worried about insurance costs. But if it's going to be a two-player market for some time, that signals to me that we've got to continue looking at pricing. What are you going to do to stay competitive on the demand side and the ridership side?
Ed, thank you, mate. Lyft is down by 4%, down by 3.8% right now. Uber's negative by close to 5 percentage points. Lyft numbers come next week. Coming up on Thursday, you know the two big names we're looking for, Apple and Amazon. City Stuart Kaiser making a case for sticking with big tech this earnings season.
Earnings growth is still relatively scarce. If you look at the drivers of performance this year, EPS momentum or positive revisions to consensus numbers have been a key driver of returns of the leadership of the market, and we think that continues. I think the core view remains tech and growth, because I think growth is still scarce both in the U.S. and globally, and it's large cap U.S. equities which have that growth. So we're not ready to pull the cord on that one quite yet.
Let's continue that conversation. We can do that with JP Morgan's Monica DeCenso. Monica recently upgrading her outlook on the equity market. Monica, let's start with that outlook. What's it driven by and what's the number now?
It's driven by, quite frankly, fundamentals for the U.S. economy that never turned out to be as bad as people thought when they came into the year. And so we were bullish equities at the beginning of the year, thought we'd get to 4,600 by year end. Obviously, we got there a bit faster than expected. And so when we looked at our outlook again and re-underwrote our thesis, we said, hey, this is a market that is stronger than we thought. And it looks like, quite frankly, the U.S. consumer is stronger than we thought. And when you add that up with reasonable valuations, broadly speaking, you can see a scenario where equities can still return 6-7% over the next 12 months.
So the numbers I'm looking at, 4,800 to 4,900, perhaps by the middle of next year. Monica, when you think about the opportunities, do they lie at the market cap index, S&P 500, or elsewhere?
Yeah, I do think this is an interesting setup for equities because you, for the first time in many years, have the opportunity to look beyond big tech. By the way, I still think tech looks fine. You still want that growth in your portfolio. But for too long, people relied probably too much on a few sectors. And now we actually look at this rally and it was very disproportionate. And it's time to look under the hood of the S&P and figure out where is their value? Where are their secular opportunities? I think you saw from Caterpillar this morning, industrials could be a place that look a little more interesting. And in fact, when you peel out those large cap tech names, you find cheaper valuations versus historical levels. So I do think it's time to return to fundamentals, if you will, look at valuations and look across sectors rather than being heavily leveraged to just one or two parts of the market.
Well, let's talk more about sectors. Outperformance in July, the banks up 10%. Let's talk about size. Small caps up 6% on the Russell versus the S&P up something like 3%. Monica, can we start with the banks? Do you see reason for that bank rally to continue?
I think you saw that rally, obviously, coming out of what happened with the regional bank crisis earlier this year. You saw everyone just sell down bank exposure broadly. And at the end of the day, there still are opportunities. You want to be selective with the regionals because there are some that have balance sheets maybe that are less strong or have more commercial real estate exposure. But broadly speaking, when I look at some of the larger banks, they still look fundamentally fairly strong. And that's both the equity side, and we also look at things like bank preferreds, which sold off very meaningfully and can be a really interesting way to get yield within a balanced portfolio today.
I noticed that you've dialed back your view on Europe, just relatively speaking, to the United States. Monica, can you walk us through that?
Yep. It's actually a quite similar story to the U.S. We called for Europe outperformance at the beginning of the year. That happened, especially when you think about in dollar terms, helped by good fundamentals, as well as obviously a strengthening euro. So today, when we look at it, just think it looks more balanced. Like the U.S., I think there are pockets of opportunity. I look at the energy sector, for example. You still have many names that are trading at deep discounts to their U.S. counterparts. And so I think it's just about being selective in sectors and stocks rather than owning the broad market as your only way to get market exposure in Europe.
So, Monica, two things. You've picked out energy potentially out of Europe, industrials potentially out of the United States. How much exposure cyclically are you taking at a time when some people think eventually this recession is going to bite and it's a mistake to extrapolate out the recent resilience through next year?
There's no doubt that after this equity rally we've seen, we don't want to be too levered to any one part of the market. I think when I look at what the market is giving us today, and that's how I think about where to add exposure, I see a disproportionate rally, right? Some sectors driving a lot of the outperformance. I see high rates and I see low volatility. And so I look at those three parts to think about cobbling together interesting returns over the next year. I think equities will give you positive returns, but do not ignore fixed income and the fact that you can get very similar returns with maybe different risk, thinking about parts of the fixed income world. And so I like to have that balance. And over the next 6 months, we may very well see volatility. You may get chances to lean in a little more heavily broadly to equities. But I think my message here is don't be scared of this rally, just be a little more selective.
Well, let's wrap it up. Let's just finish in fixed income. How selective are you being? Where in fixed income? What pockets do you like? What don't you like?
Yeah, very clear in public markets, you're not getting paid in high yield what I would want to get paid to take that risk. So you can be more conservative. I mean, we work with a lot of U.S. investors, munis, investment grade on the public side. You're still making that mid-single digit return. That makes sense. I mentioned bank preferreds, again, selectively. You can get even better returns tax equivalent. And then, of course, on the private side, there are opportunities in private credit, but we know lending is going to be tougher, and you're going to see some credit constraints moving into the back half of the year and next year. So again, it's about being selective. Although in private credit, you can get those double-digit returns by looking at the right kind of investments. And we just focus on making sure you're looking at companies that have reasonable leverage and a good runway for growth.
Monica, thanks for the update. As always, Monica DeCenso on the latest there from JP Morgan. The outlook pretty decent and hoping for more of the same through next year. Right to be constructive so far, and that's hard to push back against given the gains we've had year to date. To start things off in August, about 13 minutes into August and this session, we are negative by 0.2% on the S&P 500. On the Nasdaq, we're negative by 0.44%. Coming up next, Governor DeSantis outlining his economic plan.
We are today declaring our economic independence from the failed elites and policies that have harmed this nation's middle class.
What did that remind you of? That conversation up next.
Now it's time for the American people to take back their future. We're going to take it back. We have become more dependent on foreign countries than ever before. Ladies and gentlemen, it's time to declare our economic independence once again.
It is time to declare our economic independence once again. Former President Donald Trump running the base back in 2016. 7 years later, Governor DeSantis unveiling his very own Declaration of Economic Independence.
We are today declaring our economic independence from the failed elites and policies that have harmed this nation's middle class. We will declare our economic independence from the failed elites that have orchestrated American decline, from the reckless federal spending that has inflated prices and plunged this nation to the brink of bankruptcy. We will declare our economic independence from the Chinese Communist Party.
Governor DeSantis challenging trade relations with China and taking aim at the Federal Reserve.
We need to rein in the Federal Reserve. It is not designed or supposed to be an economic central planner. It is not supposed to be indulging in social justice or social engineering. It's got one job: maintain stable prices. And it has departed from that with what it's done over the last many years.
Joining us now down in Washington is Bloomberg's Anne-Marie. Anne-Marie, that didn't go unnoticed by the former president, did it? Declaration of economic independence.
No, it certainly didn't. But clearly, the Florida government is taking a playbook out of another Florida man, Trump. If it worked for him in 2016, I guess the DeSantis camp thinks, can it work for Governor Ron DeSantis for 2024? But what we do see, Jonathan, from the DeSantis camp, which Trump is just crushing in the polls, really across the entire Republican stage, is we see a broader pivot to talk about more than just going after, quote unquote, woke corporations. He's talking about everything from China, from taxes, energy independence, student loan debt relief. So this is a really broad economic plan, and it shows that DeSantis is trying to look beyond just his playbook in Florida and what works for Florida maybe can work for the rest of America, and really try to reach to a broader spectrum of Americas. So what you see here in a lot of these policies is the typical conservative Republican policies when it comes to the economy, but also when he talks about China and a tough stance and a harsher stance on China, that is really invoking a lot of populism that we have seen over the past 5 to 10 years from the Republican Party.
When he says we win, they lose, who is we and who are they?
That's a great question. You know, Jonathan, your production team and I were debating this. When Ron DeSantis says we win, they lose, he's really going after everyone. Democrats, bureaucrats, the elite, because he says that we need to get policies that help working class families, and of course, Beijing.
Anne-Marie on the latest down in Washington. Looking forward to Balance of Power a little bit later. Catch up on that programme at 5 p.m. Eastern Time. Let's get you up to speed on some of the economic data out moments ago. Katie Lyons has more. Hey, Katie.
Hey, John, we got the final July read on the U.S. S&P Global Manufacturing PMI. It matched the prior read at 49. So for a third month in a row, manufacturing remains in contraction territory, though that contraction is happening at a slower pace. Remember, the June read was 46.3. So this is an improvement. Still, though, new export orders fell for the 14-month running. Firms also reported, interestingly, a renewed rise in material costs, raw material costs, input prices faced by manufacturers increasing for the first time in 3 months. So an interesting inflationary read there. But on the employment read, especially, John, as we look forward to the data later this morning and throughout the week, culminating in the jobs report on Friday, companies did expand employment at a faster rate with greater confidence in the outlook going forward. So we remain in contraction in the manufacturing sector, John, but they maybe see a brighter future, and that would read through to the labor market in theory.
Katie, thank you. That's the final read of the S&P Global Manufacturing PMI. We get the ISM at the top of the hour, the ISM manufacturing number. Looking for that to come in at 46.9. 46.9. That is the number in our survey right now. Looking forward beyond that, jolts as well coming up in about 8 minutes' time. Beyond that, go to payrolls. Katie mentioned payrolls. The estimate at the moment in our survey, still 200,000 for the headline jobs growth number for payrolls. For unemployment, about 3.6%. Let's get you some sector price action. We can do that with Abby.
Hey, John. Well, we do have a small decline for the S&P 500. Not surprisingly, most sectors are lower. One that is higher, industrials up 0.3%, helped out by Caterpillar. It's interesting that we're having this manufacturing weakness, given the strength for at least one of the industrial companies, Caterpillar. Most of the other sectors, though, you can see down. Discretionary and communication services, two of those mega cap tech sectors. Well, they are both down about 0.5% or so to start out the month of August. Now, going back to July, you were mentioning earlier, China tech up 20%. Its best month since November of last year. But today, a little bit of a cooling here. The Golden Dragon China Index down 1.4%, and lots of the big players taking a break to probably a consolidation of those big games, John.
Abby, a little bit lower this morning. Abby, thank you. We're down by, let's call it 0.2% on the S&P. Your trading diary is up next. The outperformance last month in July came from the Russell, up 6%. This morning, it's where the underperformance comes from. The Russell is negative by 0.75%. The S&P 500 a little lighter. We're down here by 0.2%. That's the price action. Here's the trading diary. Coming up, the JOLTS report and ISM manufacturing numbers at the top of the hour. Qualcomm earnings on Wednesday, followed by Apple and Amazon results on Thursday. Plus, we get a Bank of England rate decision on Thursday as well. Another round of jobless claims too, and durable goods orders. And finally, on Friday, the payrolls report. The payrolls report, and what I think is the best lineup on payrolls day in America anywhere on the planet. Rick Reeder of BlackRock, Anastasia Amoroso of iCapital, Mike Collins of PGIM, Mohammed Al-Aaron of Queen's College, Cambridge, and so much more. All of that coming up on Friday. Just a few more days to go. From New York City, that does it for me. Thank you for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.